and I'm really sad that they're not, because it must be a terrible struggle for young people. But the only alternative, I'm afraid, is for house prices to come down. And to some extent, that is happening at the moment.
Friday, August 4th, 2023, Maneco 64, home of alternative economics and contrarian views. Today we have a favorite of the viewers and the subscribers, Clive Thompson. Clive, thank you for coming on the channel again.
Well, it's great to have you back, be on your channel, and thank you for inviting me, Mario.
You're welcome. Well, let's start with the U.S. credit rating. And to me, one thing that was interesting was that they mentioned something about governance, and that was more related to the debt ceiling, the fact that it's getting harder and harder for both political blocs to negotiate. But I would say, looking at the news, what's happening to the former president and also what's happening to the current president, and the fact that we're finding out that when he was vice president, there's a lot of alleged corruption to do with his son's dealings and everything. It seems to me that the United States is becoming more and more divided. So just wanted to ask your opinion on the downgrade, and maybe also on the political situation. A lot of countries, or one of the mainstays of the dollar in the last 80 years is that politically it's a fairly stable country, but it seems to me that it's anything but now.
Yeah, so Fitch is not the first ratings agency to downgrade the United States. It was previously downgraded by by S&P. That was a few years back, and Fitch have they warned, I think, back in April or May that they might consider downgrading it. They put it on negative watch. So they finally got around to doing it, and they've downgraded it to AA+ from AAA. Now, AAA is the best credit rating you could have, and AA+ is one notch below that. It's a pretty good credit rating. To put that in perspective, there are only two companies in the world which have got a AAA credit rating. Everyone else all the other good companies are AA+ or worse. And we're an awfully long way from D, which is default. But obviously it's a warning sign from Fitch to the US government that they've got to get their finances in order. And the reasons they've given for reducing their credit rating, I just read the headlines. They say erosion of governance, the rising level of the general government deficits are rising. That means every year they spend more than they receive in taxes, and it's growing. They wrote the medium-term fiscal challenges remain unaddressed. They say that the economy is about to slip into a recession, and they refer to the rising level of government debt as a percentage of GDP. And then they go on to discuss what the USA would have to do to get itself upgraded back to AAA, or what might happen and cause them to downgrade to AA or A or worse. So for an upgrade, they say basically the government's got to reduce spending or increase revenue sufficiently to result in a medium-term decline in the debt to GDP ratio. What that means is the government's got to spend less and receive more in taxes, and basically start to balance the budget, and therefore reduce the debt to GDP ratio. That's unlikely to happen from what we know, because it's not the government's plan. What will it take to downgrade the USA again is actually what's in the government's plan, not that they want to be downgraded, but Fitch says, if we see a marked increase in public debt, well, that's the plan of the government, or failure to address medium-term spending and revenue challenges, that's the plan, to not address those, and or any undermining of the reserve currency status of the US dollar, thus diminishing the government's financing flexibility. So it looks to me that the next move by Fitch, and this could be a year or two away, would be another downgrade, unless the government turns itself around and starts to spend less. But I don't think that's capable of happening the way things are set up in the United States.
I think as well what you said there, you read from Fitch that something about the reserve currency status as well that they need to maintain. But it seems to me that they're doing everything not to have reserve currency status with all the weaponization of the dollar in the last few years. So I think that's another point there. Do you think this, because last year around the same time of the year, which is coming up to the autumn or fall equinox in September. And the reason I mentioned that is because I have a book here by Franz Pick, who used to do a lot of analysis for central banks about currencies. He wrote this in the 80s, The Triumph of Gold. And in the forward here, I think it's Henry Jarecki. I think he founded a gold dealing company, and he was a friend of him. He said, in the introduction about how he decided to short the British pound in 1931. And he said, on September 21st, 1931, sterling was devalued and Paycheck made $1 million. I think he was the head of the Czech central bank, who was a friend of his. Why do you mention the equinox? I asked. That's the guy who wrote the forward. I asked this hyper-rationalist, and he replied, I have a theory about devaluations on the equinox. I published it once in a book. And he says, I learned currency from Knapp. Pick continued, referring to Georg Friedrich Knapp, the Prussian professor of monetary theory, who wrote that Das Geld ist ein Geschöpf der Rechtsordnung, that money is a creation of juridical order. So what I'm trying to say here, last year I was warning a little in July and August about the UK gilt market, and then we had the crisis September, October, right around the 21st or 23rd. I don't remember exactly when it was the equinox last year, but we've seen that US Treasury yield, the 10-year, has gone up from below 4%. We're now approaching 4.20. I think the 30-year went up to 30. So do you think this could be a trigger for a crisis in the next 6 weeks or so? Or do you think things are going to calm down in the bond markets?
Well, first of all, what's going to happen to the bond market? The US government needs to keep raising cash through the treasury market by selling treasuries. And the reason it needs to raise it is because it has a plan to spend a lot more than it's earning in taxes. So as far out as the eye can see, according to their own plan, they're going to keep raising money. That means they're going to be tapping the market for selling bonds. They'll be selling more treasuries than they are redeeming. And unless the public's got a huge appetite for them, that means interest rates will be forced higher. Probably not a lot, but you never know if we suddenly get a crisis. But I think if we get a crisis, the Federal Reserve is standing ready to step in and start buying those treasuries to stop yields getting out of control. Of course, if the Federal Reserve steps in and buys the treasuries instead of the public, that is quantitative easing. The Federal Reserve will be expanding its balance sheet. It means it will be printing money and giving it to the government whilst taking in at the same time the government bonds that they printed. So the money supply will be going up. It will be inflationary if that happens. It's not the words being used by the Federal Reserve. They're talking about quantitative tightening still. They have been reducing their balance sheet very, very slowly, and they say they will continue to do so. But you can imagine we only need some small crisis or event for them to say, oh, well, we have an excuse. So I don't really see it turning into a crisis unless we have some unforeseen event. I see a continuation of the same, rising interest rates, and a bit of a squeeze on everybody who's borrowed money.
Yeah, I guess they could also use the excuse of yield curve control and not call it QE, just like the BOJ does.
Yeah, so that would yield curve control basically means that they step in and start buying the longer dated bonds to stop the longer rates of interest from rising. That's another tool at their disposal, but it's the same thing. If they buy the bonds, they print the cash, and the cash comes into the system.
That's right. Yeah, today, just to let the viewers know, we have the U.S. non-farm payroll data. That will be important as well. But I agree with Clive about bond yields. They will have to rise a lot more than most people think, in my opinion. And I think the markets and the mainstream economists, they've been behind the curve. And talking about being behind the curve, we're going to move now to the UK because Clive has got some stuff about the UK housing market. Just want to find, and before we look at that, Clive, I just wanted to show you and the viewers, there's something in the FT, which is a very, I subscribe to the FT because you have to know sometimes what's going on. But I would say they're very biased towards the central banks and governments in the West. And it says here, Andrew Bailey's medicine finally appears to be working. BOE governor declines to declare victory, but inflation is expected to continue to fall after a protracted series of rate rises. One thing I would say is that he was saying the same thing back in 2021, and even in 2022, that if inflation was going to drop by the beginning of this year, it hasn't. And this is an interesting comment he made here, Clive, that makes me think that he's in denial, or he's been going to Egypt for too many holidays. He says, Bailey said that while the BOE could learn important lessons on how to handle big economic shocks, such as Russia's full-scale invasion of Ukraine, he said, I do not think we got monetary policy fundamentally wrong. And I think that's pretty dishonest, or it maybe, as I said, he's in denial, because CPI, what they consider inflation, was already rising prior to the invasion of the Ukraine last year. And no mention of all the money printing he did during the lockdowns, or the fact that he cut rates virtually to zero. So, yeah, maybe you could.
Yep. So, obviously, prices were rising, and they've been rising as long as I've been alive. There's nothing new in that. It would be quite unusual to have negative inflation. And one thing I think people, although we're seeing what they call falling inflation now, we have to be aware that falling inflation does not mean that prices are going down. Inflation is cumulative. So inflation might have come down from 10% to 8% or whatever the figure would be, but it doesn't mean to say that prices are falling. It means they're still higher, and they're just rising at a less fast rate, a slower rate than they were rising before. So, if you had last year 10% inflation, next year you have 8% inflation, that's 18. That means prices are 18% more expensive. It doesn't mean to say that prices are lower than they were. So although we'll hear a lot of words, if the official CPI rate of inflation comes down saying that inflation is falling, don't be fooled into thinking that prices are falling. That's not the case. And Mary, I know you've mentioned it many, many times. There's a very important distinction between the retail price index and the consumer price index in the UK. Retail price index is what they were using when I was young, and they moved over to the consumer price index at some point because it kind of made sense to have a lower inflation rate, inverted commas. The key difference today between the retail price index and the consumer price index is that the retail price index includes mortgage payments, whereas the consumer price index does not. The consumer price index does include housing costs and things like electricity and rates and council tax and things like that, but it doesn't include the mortgage costs or the cost of housing yourself. So the retail price index is at a rate which is somewhat higher than the consumer price index. And given the way interest rates have gone, it means that over the next few years, as people's fixed rate mortgages mature, their mortgage costs are going to go up. And that does mean that the retail price index, irrespective of falling food prices, which is to some extent happening now, the retail price index should continue to rise. Mario, do you think I could show a few slides, perhaps, at this point?
Can I just show you one more thing about CPI? Because many people, I haven't seen anyone but myself mention this, because this is the Bank of England inflation calculator, and I've been looking at this for quite a few years. And I noticed last year that all of a sudden the numbers seem to have gone down. And this is why it says here, and they don't hide the fact, but it says, please note the estimates in the calculator from 1949 onwards have been updated with revised CPI estimates from the ONS published in May 2022. So I went back to a video I did a few years ago, where the Bank of England, while the CPI averaged from 1997 to 2020, 1997 is when they were set the target of 2%. The average was 2.7. So clearly the Bank of England missed its target. But now if you go back and you do 1997 to 2020 again, it's magically dropped to 1.9. So just wanted to warn people that they're going to keep tweaking with this CPI. And basically, it's not lying, because they tell you they're doing it, but they don't publicize it. So I'll let you share what you have to share now, Clive.
Yeah. So another comment on the CPI, when you buy something at the same price as last year, but there's been a technological improvement. For example, you buy a new television, which last year you'd have paid, I don't know, £1,000 for a television. This year you buy a television, £1,000, same price. That ought to keep the index the same, but it's called a price reduction because this year's television has more features and more gadgets and more whiz-bangs than last year's. So they put that in as a price reduction, even though you have no choice. You've got to pay the same amount of money.
That's called hedonics. But hedonics. But the thing about that is that your wages haven't been upgraded. So, yeah.
So let me just share a screen with you if I can.
Let me enable you here. Multiple point. Okay, there you go. Sorry.
Right. So can you see the screen now, Mario?
Yeah, we can.
Not sure which one I'm looking at, but I hope you can see it. Oh yes, I see it. Yeah. Okay. So we're looking at this is a long-term chart for the last 23 years of income salaries in the UK and Wales compared with house prices in the UK and Wales. But let's start off with the bottom line. The very bottom line, you see the green dotted line. That is the official inflation rate according to the CPI index.
Yeah.
The next two lines above, where my mouse is, are the salary levels in UK and Wales as starting from an index level of 100. So you can see they've gone from 100 to about 230, 220 now, compared with 1999. So a bit more than double. And then the top two lines are the house prices in England and Wales, which have gone up 3 to 4 times, 3.5 to 4 times. So you can see, first of all, house prices in the UK have risen a lot faster than salaries have risen, and much, much faster than consumer prices have risen. And the reason for that, we'll get to in a minute. I'm going to show you some slides which will explain that. But perhaps we'll just move on to what the UK interest rates are doing in the UK. We've had... Sorry, Marianne.
I would say, the average, is that the average wage? I would say...
that's the, what do they call it? Incomes in England and Wales. So I suppose it's HMRC data on people's income.
Because I would say the average person out there, if you go to a young person starting out, they're not getting double of what people used to get in 1999. But anyway, that's a different story. I'll let you continue.
So here we are with the whoops, I jumped a bit there. Go back. We've had the 14th tightening a few days ago in the United Kingdom, 5.25% now in the UK for base rate. obviously that has an impact on mortgage rates. But I just want to put the interest rates in the UK into perspective over the longer term. Here we are going back to the 1970s, where you see we had long periods of rates in the 10 to 16, 17%. And if we go back much further to almost the beginning of time, the 1800s, you can see the rates were pretty much a little bit higher than they are today. That's just interesting anecdotal. What I'm showing here is a chart from the Office of National Statistics, which shows you what multiple of your income you need to buy a house. And I'd like people to focus on the white dot in the middle. There's for London, for example, there's at the left-hand side, there's a blue dot, then it goes through to white, then it goes across to orange and red at the far right-hand side. So the dots represent the quartile or the percentile of income. So the highest income earners in London, the top 10%, would have to pay 5.5 times their salary to buy a house. But the average Joe, the median, would have to pay about 14 times his income to buy a house. And the poorer income earners would have to pay 37 times their income to buy a house in London. And as we scroll down the chart, we can see it gets a bit better for the southeast, where it's roughly 9 or 10 times, east of England 9 times, southwest about 8 times, West Midlands about 8 times, northwest 6, 7 times, and so on. And we get down to the northeast, where you're paying about 5.5 times your income if you are a median income earner. The poorest are paying 11 times their income, and the richest are paying 2.8, 3 times their income. So what that shows is that it is quite expensive in terms of a multiple of income, because it was never that expensive some years ago. And if we look at the historical trend here, so for each area, you see a chart showing the multiple of income you need to buy a house. And it's looking at for a 20th percentile household income. So you can see that this is for relatively poor people, the people who are on lower than the average. In London, they're paying 26 times their income to buy a home, and in the Midlands, 12 times their income to buy a home. But that's been rising. If we go back, let's take the West Midlands as an example. 12 times your income to buy a home now. It was 7 times your income back in 1999. So it's been rising. So it's becoming, for the UK people, a lot more expensive to buy a home.
Yeah, and I think that's got a lot to do with the fact that they've kept interest rates artificially low. I think not only prior to 08, but also after 08. And because I'm reading a book right now about The Price of Time by Edward Chancellor, and he knows that people like John Locke and others in the past, they all noted how the keeping artificial low interest rates artificially low usually helps asset prices, and I think that's what's happening. Anyway,
well, if you look at this chart, you can see exactly that. The interest rates were lowered in 2008, where my mouse is moving here. And you can see back in 2008, to buy a house, for example, in the UK as a whole, not London, in the UK as a whole, it would cost you 5 times your annual income on average to buy a home. And then the UK as a whole now, it's 7 times the average income. And that's, as you say, Mario, it's been propelled, the rate multiple's been propelled higher by the much lower interest rates.
And what's the orange line? Is that like London?
The top line is London, which is showing you need for the average income 11 times your income, and the bottom line is the north of England, where you need currently nearly 5 times your income, compared with below 3 times your income back in 1983. So it's been the amount of income you need to buy a home today, and this is, by the way, this chart peters out at the end of 2022. is much higher. The figures might have been changed slightly now with falling house prices.
It's interesting, Clive, because I was in North Yorkshire a couple of weeks ago, and we met a lady in the hotel. Actually, it was outside because my wife went out for a cigarette, and I went out with her. And there's another lady there, and she was local, and we we're talking about house prices, and she was complaining that a lot of the Southerners, the Londoners, go up there and drive the prices up. So even despite the fact that up in the north or Yorkshire, it's a lot more affordable, people over there, they complain because I think their earnings are on average lower than ours, so they're feeling it too.
Yeah, I mean, people in London and the south simply can't afford homes anymore, or many of them, and they're being forced to go somewhere further afield. And especially now when you can work at home. For some people, they're saying, why do I need to be in London? Where am I? It would cost me an arm and a leg to buy a house when I could go north, get the same salary, because I'm earning a London salary, I'm employed by a London firm, but I can buy my house up north. So there's some of that going on, and that will be bidding up the prices. I can see how people are aggrieved that all these people are coming into their area, bidding up the prices, pushing it out of reach from the people who are earning a salary locally.
Yeah, go ahead.
So just moving on.
Yep.
This is the cost of mortgage payments for first-time buyers as a percentage of their take-home pay. So first-time buyers, percentage of take-home pay, the amount which is being spent on a mortgage. And it goes back to 1988. And it shows the warning levels. Well, the warning levels were times when house prices did fall in the past. And what you see on this chart as of, it's updated to Q1 2023, house prices, or rather interest rates are rising now, and that's causing the level, your income expenditure on a mortgage is typically now 45% compared with a long-term average of around 30%.
It's interesting.
More expensive.
It's interesting, Clive, if you could put that chart back, that the cost for first-time buyers has been so low, and people might ask, how can that be if prices have been going up? Well, it's because interest rates have been really low. And I read an article a few weeks ago that especially in the Southeast and in London, a lot of people who are better off, they're like in that 10% quartile, like the highest earners, they've been taking huge mortgages and also interest-only mortgages, and I think they're going to be hurt too. It's not just going to be the first-time buyers.
I think the other thing to be aware of is what's actually happening to the housing market in the UK. It's literally seizing up. The number of transactions has fallen through the floor. And the reason for that is buyers will only pay what they can afford to pay for a mortgage. So if, for example, you had a 100% mortgage, I know you don't normally do that, but let's say you have a 100% mortgage and the interest rates double on you, that means you could only afford a house at half the price of before. Now, obviously, most people don't have a 100% mortgage, and part of the outgoing will be the capital repayment. So if we factor that in, it still means that house prices will be lower. Now, for the average first-time buyer, or for any buyer who's taking out a new mortgage, interest rates have, in fact, doubled. So if they were borrowing only 50% of the value of the house, and most people do borrow more than that, it would still mean a 25% reduction in the capital value that they can afford. So what's happened is buyers, the price they can pay for a house is driven by the outgoing payment, whereas sellers are still, to some extent, clinging on to the hope that they'll get last year's price. Of course, we've seen quite a few price reductions in the last year or so, especially in recent months. But we're still talking about house prices only about 15% below where they were. I think, unfortunately, there's some way to go if interest rates continue to rise or even stay where they are.
Yeah, I saw, I think last week was the nationwide, or earlier this week, it dropped, the average UK house price dropped 3.8%. in the last year, and that's the biggest drop since '09. But I think it could get a lot worse, as you say.
Well, here's a forecast from the Nationwide.
I see.
The as of the current year, which is they've got it updated to May this year, they are forecasting from here a 15% fall in prices.
Yeah, and they're building.
I hope they're right, because it could be worse.
Yeah, and I guess they're maybe talking a little bit their book, because they are a lender.
Yeah. So basically, what you see on this chart is the house prices were close. The average house price was close enough to £280,000. Currently, they say it's around £260,000, and they see it falling to £220,000. So on a £280,000 house, they're seeing a £60,000 reduction if their forecast is correct.
Yeah, and I think the government, the chancellor here, they're desperate to keep rates, the Bank of England rates, as low as possible. And they're also, I think they've met with a lot of the lenders, mortgage lenders and banks, to try to, to have some kind of agreement to make it not so hard on homeowners. But I'm not like trying to like say, oh, hopefully this will happen and everything will crash. But what do you think is gonna happen? And do you think that in a way this is a bad thing for house prices, but it's just natural? It has to revert to the mean, because what's the point if people can't afford to buy houses, especially young people?
Yeah. So I mean, obviously, there's two sides. There's two sides here. There's the Bank of England, Andrew Bailey. Is he going to take orders from the government to lower interest rates? And there's the other side. Is the government going to do something to help home buyers? I don't know if you remember something which used to be called MIRAS, mortgage interest rate. I don't know what it was, but basically it allowed a deduction from your taxes.
Yeah.
That might be the stimulus which is needed, because it would make mortgages more affordable in the UK. But on the other hand, it would reduce the government's revenue, which at the end of the day means they've got to borrow the difference, which would be inflationary and would push up interest rates. So it's a bit between the devil and the deep blue sea. But maybe some sort of tax relief on mortgages might be the answer.
I see.
Let's just move on. I mentioned that the housing market is seizing up. This is up to Q1 2023, and it's a chart of the number of new mortgages granted in the UK. And what you see as of Q1, and we're 4 or 5 months on from that, as of Q1, the number of advances for house buying have significantly dropped. And as a corollary, more and more young people are living with their parents. As you see on this chart, it used to be 36% of young adults living with their parents. The figure in recent years has risen to a record of 42%, because they can't afford to get a home of their own. So what's going to happen to house prices? Well, we have, and I don't want to say it's a positive or a negative, but it's a fact. Population of the UK is forecast to keep growing. You can blame it on what you want. I don't think it's that the Brits are having more babies, but certainly the population is forecast to grow from 67 million to in a couple of decades to 72 million, and that will create the need for more homes. Yet, at the same time, in the UK, the number of new home constructions over the last few decades has been constantly falling. So the local councils, who used to build a lot of houses back in the 1940s, 50s, 60s, 70s, 80s, have gradually been reducing the number of houses, and it's virtually nothing now, and it's been turned over to the private sector. But the private sector is also not producing very many houses. The number now is, for the private sector, back in 1989, the private sector was producing a couple of 100,000 houses a year. The local councils were building a couple of 100,000 houses per year. That was 400,000 houses together. Now the private sector is producing only 150,000 houses a year, and the public sector, zero. So we've gone from 400,000 houses a year being built to only 150, and that is one of the factors which has created a squeeze on house prices, albeit that with the higher interest rates, the prices will probably have to come off now somewhat more.
Yeah, and the local councils now, I guess, they're not in very good financial situation, so it's going to be even harder for them to. And I think it was during the Thatcher years that I guess but it started to drop before the Thatcher era. I can see here, and it started to drop in the mid-70s, and she came into power in 79. So a lot of people blame Thatcher, but if you look at the trend, it started dropping really in the 50s and 60s.
Yeah. Well, the other thing which went on in the 1970s and the 1980s was Britain adopted a policy which was designed to raise cash of selling the council houses, these are the publicly owned houses, to their tenants at what actually was a knockdown price. So the man in the street benefited in two ways. One, he was buying his house at below market value, and two, he had the advantage that he bought into a housing market when house prices were rapidly rising. So at the time, that raised a lot of money for the government, but of course they've got nothing left to sell now.
I see.
I thought I'd put this up. We talked about UK inflation. The top line shows that this is an inflation chart in percentage terms annualized of UK, France, Germany, the European Union, and the USA. The highest inflation rate of those five is the UK, which is the blue line at the top left on the right-hand side of the chart, obviously showing around 7.5% now, or 8%. Yeah. Whereas the USA, we're showing around 3%, which is the green line at the bottom. Just it shows that the UK at the moment is a little bit of an outlier in terms of the inflation rate.
So, Clive, we've spoken about the U.S. credit rating, the situation in the bond markets, currencies, UK housing. So, to wrap things up, maybe you could tell the viewers, be they investors, people who have saved a lot, who are older, and also people who are younger, not just in the UK, but everywhere around the West. What do you think is the most important thing financially for people to keep in mind and also to guard against in these uncertain times? I mean, they are unprecedented because we've come from an unprecedented period of very low rates. And now it seems like the central bankers don't really know what they're doing and how to solve the problems.
Well, at the moment, our interest rates remain well below the rate of inflation. So if you're putting money on deposit and keeping it for the long term, it's going to buy you a lot less down the line than it buys you today. So my first comment is, if you don't need the money you have in your bank account for the short term, you shouldn't leave it in cash. It's not actually doing what you need to do. And if you've got enough money to pay off your mortgage, well, rather than pay off your mortgage, perhaps I would think of putting it into something like gold or silver or some other tangible assets that you can liquidate. Because if we get into a situation where there's a failure of the monetary system that we're in at the moment, and there's multiple ways it can fail. I've discussed on your channel one or two ways, such as a currency reset, but there are other ways it can fail. If there's a failure of the monetary system, you'll be left with a mortgage. You start with a mortgage at a house. If you've got it in gold and silver or some other tangible asset, it will still buy you things. And then you could sell those tangible assets to pay off your mortgage. Now, I'm not suggesting that anyone should put 100% of their money into any one thing, not 100% into gold or equities or property or anything else. But certainly it makes sense to have a diverse collection of tangible assets rather than having it in cash where you're going backwards in wealth terms.
And what about for, let's say, young people here in the UK, or even people in their 30s and 40s who are finding it difficult with all the rising cost of living, the unaffordability of housing?
Well, first of all, let me preface what I'm going to say by warning that I think some people might think that I'm being very smug when I say what I'm about to say. So I'd like to sort of say I feel really terrible for the young people who are trying to buy a house. It is terribly difficult and it's a real hardship. But I'm going to tell you what I did when I was young. But to say that young people could do what I did, no, they've got to do a lot more, because unfortunately things are a lot worse. But when I bought my first flat back in the late 70s, I guess it was, it was very tight, and we had interest rates at the time of 12%. So to do that, I had to have two jobs. I was working 7 hours in the day in the city of London, and then on the way home, I'd stop off and work 4 or 5 hours in the evening. And even then, it was going to be tight. So I had to move in a lodger. Well, it was a very, very small flat. It was only a 1 bedroom. So actually, it was my girlfriend, but she helped pay some of the bills. And we only had 1 bedroom and actually a very small bed. You can imagine how inconvenient that would have been to me. But anyway, it was hard. It was hard to pay the bills, and we had no television. We couldn't eat meat. We had none of the pleasures that we have today, like Netflix or iPhones or gym memberships. None of that. It was pretty hard work. But it was a struggle even back then to pay for a house. And then we had a rise in interest rates, mortgage rates, to 15%, which hurt even more. But I had one thing which saved me, and I'm very grateful for that with hindsight, which I'm really sad that young people don't have that today. And that was rapidly rising salaries, because we were in an inflationary environment. So whilst my mortgage payment went up from 12 to 15%, the salary was rising at a much faster pace than that. In fact, it didn't take too many years for my salary to double. And that was happening to people all over the UK because they were getting 15, 20, 30%, even sometimes pay rises. So it quickly became possible to manage the interest rate increases. Now, I wish that people were getting pay rises of that sort of level at the moment. And I'm really sad that they're not, because it must be a terrible struggle for young people. But the only alternative, I'm afraid, is for house prices to come down. And to some extent, that is happening at the moment, and it may continue to happen. I can't say for sure, but it looks like it to me. So those who want to buy a home, if you haven't got enough money to buy a home at the asking price, put in an offer below the market price at the price you think the house might be next year, if you can afford to pay for it, and see what happens.
Great. Thank you very much, Clive. And we're going to keep in touch, of course, and we're going to see what happens later on today in the markets. And maybe you could tell the viewers what you're doing today in terms of you've got something to do with blockchain.
Yes, so nothing special, but I get invited to a lot of investor-type conferences. So today I'm attending a conference online. It's a YouTube conference, or not YouTube, but it's a Zoom conference on blockchains and crypto investing. The company which is doing it has a little bit of my money. They'd obviously like more, so that'll be a lot of fun to see what they've got to say. But I'm not inclined to add any money to the crypto market myself. But I'll certainly listen to what they've got to say.
Great. Thank you, Clive, and have a great day.
Thanks very much. Thanks, Mario. Bye-bye now.
Bye.